everyone. Happy Friday. Welcome back to another episode of The Lens with Craig Shapiro and Larry McDonald. This week, we're going to touch base on the greatest conversation we had this week on our Bloomberg live chat. Again, we have more than 150 contributors all around the world, and we're looking for you to join us. If you're interested, please email info@thebirdshopsreport.com. Craig, Larry, go ahead.
Thank you, Val. Craig, good to see you, buddy.
Larry, how's it going?
Good. So I want everybody to. I'm so proud of what Craig's doing in the Discord room, because if you're coming out of a long meeting, you can hop in the room and get a conversation going with the top institutional investors in the world, the top family offices, wealth managers. It's on Discord. Craig's running it. And Craig, in the Bloomberg chat the last 2 days, I've been noticing a shift globally where more and more institutional players are focused on the budget versus tariffs. And I think you've been on the phone with people on the Hill. Walk us through what's happening. There's this Freedom Caucus is causing some waves on the Hill, and why does that mean for investors?
Yeah, that's right. I mean, we've been stuck in trade and tariff world for the last several months, and with the pause over the weekend between the U.S. and China, which came out Sunday night, the market has rapidly priced out the worst case economic outcomes. We've had a big rally this week. Folks feel much better about where things in the economy will ultimately end up. And so with trade on the back burner here for the next 60 to 90 days, most likely, what's the next thing coming down the pipeline? And that's the budget. That's the reconciliation process. It's the budget for next year. And so, folks want to understand better about, how big the budget deficits are going to be or not, how they're going to be funded or not. And so you have this dual part of the Republican Party that's sort of battling with each other. You have very conservative members in the Freedom Caucus who are on the budget committee, who want big cuts to spending in order to pay for these tax cuts that Trump's looking for. And then you have more moderate members in.
And what's the Freedom Caucus? About 30. So the House majority is small on the Republican side, and the Freedom Caucus is 30 members. So they're a powerful 30. 30 players, right?
And what we just saw literally in the last hour or so is the budget committee. 5 members of that budget committee voted no for this proposal to be pushed through committee. So the Freedom Caucus punches above its weight on the budget committee. So they couldn't even get this package out of committee as it stands right now. And part of the issue is that the SALT exemptions for California and for New York, high local state and local tax states, the caps were escalated to big levels, and in order to pay for that, the Freedom Caucus is looking for pay-fors. And so, as the bill stood, right now,
but why should investors care?
Well, I mean, basically, what we have budget deficit spending has been the story for America, for risk assets for quite some time. Through COVID and extended through the Biden administration, big deficits, 6, 7, 8% of GDP has led to more liquidity in markets, more liquidity in the economy. And the Trump administration came in on a mandate to really cut spending. It really was going to take a ratchet to that to bring down inflation, to bring down yields. And if they're not going to do that, and I think you saw that this week in the bond market, bond yields have been up all week. With the exception of the last, let's say 24 hours.
I mean, Craig, have you seen in the last 10, 20 years, oil prices this week with bond yields moving the other way?
Yeah, look, I mean, it seems like the bond market, I don't even want to use the term vigilantes, but there's an element of the bond market now as the U.S. is shifting composition of ownership from foreigners to more domestic players, to more levered players. There's more price sensitivity here to yields, and folks want to understand better about are they going to be paid back in deflated dollars or not? And so, with oil coming down and some of the other inflationary pressures coming down, which we saw this week, you would have assumed that the bond market would have rallied. But really, we're in this place now where folks are a bit concerned with some of the talk coming out of DC that this budget's going to just raise debts and deficits by similar amounts that we've seen over the last couple of years, and to put another $4 trillion of debt on the balance sheet. And so that's why 30-year yields almost hit 5%.
And
24 hours ago.
Spending's up 9% year over year, and the Republicans would say that the first 3 months of the fiscal year, we started, I think, October, November, December, and that's where you had a big chunk of that 9%. But we're still up 9% year over year, and if you're the Freedom Caucus, that's a problem for Chip Roy and that crew. But I think what I'm hearing from clients is the reason why they're really concerned is that the House and Senate bill have to be merged in the next 30 days. And then you have the debt ceiling. So if they don't get this bill passed next week in the House, and it's like you said, it's coming out of committee now, what that does is it pushes the timeline of reconciliation, the merger of those two bills, it pushes it out and closer, and basically it raises the probability of a stressful, what we call debt ceiling showdown, which would probably be in July. And then at the same time, that term we keep hearing in the options market, windows of weakness, and a couple of our friends on the option side have coined that term. And if you think of what's happening this week, I think you've got equity expiry today, and then the VIX expiry on Wednesday.
Correct. And
walk us through, so what I find interesting, and I'm getting this from 3 different clients in 3 different countries, that you have this showdown in the House next week. At the same time, you get the VIX expiration and the equity expiration, option expiration, and all kind of coming together. And walk us through the phenomenon of this windows of weakness, where after the expiration, some of the hedges come off, and that's where the market gets a little bit weaker relative to the support of that expiration. Is that the way to point it?
Yeah, look, there's a regularity, obviously, to the calendar, and every third Friday of the month, options expire, and every third Wednesday of the month, VIX options expire. And so what winds up happening as you get closer to the expiry point, those flows, those dealer buyback flows to help hedge those positions become a bigger percentage of the overall volume of trading. And so if there is not fundamental data or fundamental players that are in the markets doing things, then that systematic flow of those dealer buybacks really just overwhelm. And so what we've seen this week after the China news on Sunday, Monday, is that vol has completely been decimated. And so those buyback flows have taken on an even larger and larger weight.
And Craig, one of the clients made the point that you think about the last 4 weeks, and if I'm forgetting one of these points, please let me know. But you had 4 weeks, you've had Mag 7 earnings, then you had jobs, right? Then you had Pakistan and India, that tension. So all this hedging, right? All this vol buying. And then you had the vol buying into CPI and the Fed meeting, right? So you think about vol players, people tend to hedge into those events. And when you have a confluence, a concentration of those events all kind of now are in the rearview mirror, then a lot of that vol hedging comes off. And then you get this VIX crush into Memorial Day. And one of the things that we've been talking about for years, Robert Ben Battenberg and I put together a model where if all you did, Craig, the last 5 years is kind of ease into a long volatility position, into those holiday shortened weeks after one of these classic vol crushes. Walk us through how many players were long vol into these events. Now they've unwound into option expiration, and then how that kind of that's really creates the vol cram down.
Yeah, I mean, we had through the early part of April, just massive put buying. Skew was very expensive, and call skew. The price people looking to pay for upside calls was in the 0 percentile. No one was thinking that this market really could move higher. And so what we've seen over the course of the last several days is actually put to call ratio has been decimated. Their puts have been thrown out, baby with the bathwater. There's no more hedging. There's been a reach for calls, particularly on the single name basis. And that's been exacerbated by some of these leverage ETF flows. We've talked about this before, double and triple levered ETFs into Mag 7 names and into big tech names have an outsized impact on end of day volumes. And so the market has rapidly shifted to a long posture here. Vol control funds have started to buy back. CTAs have started to buy back.
Now the vol control funds are back.
Yeah, so we're not at maximum leverage again for the systematic place, but we're a much improved place from where we were, say 15 to 25 days ago. And so the markets have come quite some way here, have chased, and now we're going to lose today with this options expert. We're going to lose a lot of that call buying that's gone on. And so the window of weakness kind of represents the idea that those buyback flows from dealers will be less important because we're further away from expiry. And that just means that the potential for fundamental data points to actually matter rises, because fundamental players have the potential to be a bigger part of the volume earlier in the month, which is where we're going to start, come Monday. And so if we have some worries about the budget process, there was also a comment this morning from Trump about tariffs, where he said, outside of some of the big countries we're negotiating with, we're not in any position to negotiate with all 150 of our trading partners. So we're just likely to, in 2 to 3 weeks time, just set a rate, and that's what they're going to pay. And so we're reintroducing some time risk at the end of May, maybe the early part of June, which jives with the payroll print and some of the May data coming out. So I think after we lose the weekend and into next week, folks are going to start thinking about what are some of these risks. Again, is the economy slowing? Are the tariffs? Have we seen the best case scenario already for tariffs? And is the budget process moving along smoothly? And if those things don't go according to plan, buying volatility again here in the mid-teens, I think is going to make a lot of sense.
Yeah, and I just want to clarify in terms of the holiday shortened week, the modeling that we've done. All that means is when you have a 4th of July or Memorial Day, a lot of players are not around, Passover, and when there's less players around, volumes get lower, and vol sellers and vol control people, they kind of can run the show a little bit because they can sell vol without as much risk in typically on a holiday shortened week. And so to your point, when you have all these events, you get Mag 7 earnings, you have CPI, jobs, Fed meeting, the China Trump talks, or dissent talks over the world. So all that hedging is unwound into a holiday short week that gets you a tremendous amount of vol crushing. And typically that type of an event creates an opportunity because it's such a concentration of selling in a short period of time. And I think it's weird that it's lining up with option expiration and then now this new stress point in the house, which potentially causes a lot of stresses on the debt ceiling. But I think, Craig, I got to hop because I got to go to a lunch. Anything you want to say? First of all, thanks for everything this week. You kicked ass again, and thanks for being there. I want people to join Craig in the Discord room. Reach out to info@thebeartrapsreport.com to get into the room. Join us on Bloomberg. Reach out to me on Bloomberg. Any closing thoughts, Craig, on the week?
No, look, like I said, I think next week's a little bit light on the macro front, but DC will take center stage, and then we have Memorial Day, and people start to go away Friday. We're off the following Monday, but then after that, it's going to be month end. It's going to be NVIDIA earnings on the 28th, and into the June, job stuff. So, it seems complacent now. Trump was away all week, and we didn't really have much in the way of overnight headline risk. It was nice for a change, but he typically likes to, when he gets back, shuffle the deck again. So we'll be on the lookout for, progress on trade deals and tariffs and, what's the momentum. And I'm sure he's going to do a press conference next week where he may or may not say something that bothers markets. So we'll see. But it's, markets have come a long way off the bottom. And I think people want to believe that, maybe it's, new highs are in the future. And so we'll see. There's still a lot of wood to chop between now and then.
Special thanks. We hit, sorry about that. We hit, we're in the top 5 this week, pretty much all week. Top 5, top 10 in the money and finance categories. How to listen when markets speak. Special thanks to David Einhorn, David Tepper, Charlie Munger, Neil Ferguson, all incredible contributions in here. And Craig, we'll see you next week, buddy.
Thanks. That's good. Thanks, Larry. Take care.
Okay.
Bye-bye.
Thank you, Larry. Thank you, Greg. It was such great conversation, and thank you everybody for joining us. Please make sure you reach out to info@thebeartrapsreport.com if you're interested in our Discord chat, if you're interested in our Bloomberg chat, our turning point. our one idea. We're waiting for you. This is the perfect time for you to come in. So reach out, make sure you grab our latest bestseller, How to Listen When Markets Speak, now available in Portuguese, Japanese, and Korean. We'll see you next